Hi, I'm David Scranton, and thank you for clicking this video. Yes, it's that spooky time of year again, and today we're talking about some scary retirement facts. Everyone likes to be scared when it's Halloween, of course, but no one wants to be afraid of retirement. So now, to help us out with this topic, I want to bring in today's special guest, Eric Lardner, founder and president of Abundant Wealth Management, a retirement income store in Dallas, Texas. Eric has over 30 years of experience working in financial markets. Eric, great to have you with us today to talk about this Halloween special topic.
Nice to be here, Dave.
So, in your own words, tell us what you find in your experience is the scariest part of retirement for most people who are getting close to that time.
Well, usually in my experience, most people are very concerned about making sure they have enough income to, maintain their lifestyle and not have to worry about outliving their money. Oftentimes people run into a situation where they have to consider perhaps going back to work or cutting back on expenses. And those are certainly the scariest things about retirement.
So in general, I get it because, right, you people get a paycheck, they're used to it, and then they give up that paycheck, and now they've got to recreate that income for the rest of their lives on their own in a way that they're just really not used to. So let's drill down. Let's get more specific. What are some of the maybe scariest facts about retirement that maybe people should know, but they don't necessarily know?
Well, many people are positioned incorrectly in retirement and relying more on growth of their retirement savings rather than generating income streams. This actually exposes them to greater risk, volatility, and sequence of return risk, which increases the likelihood that they'll have to consider perhaps going back to work, reducing their lifestyle, or perhaps outliving their money in retirement.
So Eric, I know you mentioned this term, sequence of returns. I know a lot of our viewers don't necessarily know what that means. So explain, please.
Well, by way of example, Dave, there was a 13-year period starting with the dot-com crash in 2000 where there was zero growth on the S&P 500. That included the financial crisis. So we had two major drops in the markets, and that's what we would identify as sequence of return risk. No one knows when the market's going to go up or down in many cases. And oftentimes we have surprises. For example, the COVID crisis. No one knew that was going to happen, and that is another example of sequence of return risk.
And the reason it's called sequence of returns is because losses in your first few years of retirement are much more devastating for somebody's money and lifetime income than losses maybe on the tail end of retirement. So in many ways, though, correct me if I'm wrong, but retirement is more challenging today, maybe, in terms of people trying to invest for retirement than it was 20 or 30 years ago. Do you concur?
Absolutely, 100%. For one thing, pensions have largely disappeared and been replaced by 401k plans. This leaves investors largely on their own to select from a limited pool of bond and stock mutual funds. And since the financial crisis, the Fed has been artificially keeping interest rates low, which makes investing for income harder than ever. There's a right way and a wrong way to do it, and it most definitely requires a specialist.
And it requires a specialist because most people don't really understand all their financial options that are available to them. In some of these previous periods, you're right, you had stock mutual funds, bond mutual funds. There were two tools, and they worked in some combination. And you throw in bank accounts and CDs that were paying 6 and 7%. It was great. But today you need different tools that a lot of people you talk to probably aren't aware that they even exist or how they work when they first meet you, right?
Absolutely. It's there's a universe of bonds and bond-like instruments that can be utilized. Most people don't realize that it's actually less volatile and less risky to invest for income, creates more consistent, reliable returns, and people can rely on the income stream in retirement rather than the growth on their retirement savings to supplement their income.
You know, it's interesting you say that because, you said bonds and bond-like instruments, and 20 years ago it was stocks and bonds. The only thing in the bond-like instrument category was really bonds. But now, of course, if you rely just on bonds, you're not getting a lot of interest, right? 10-year government bond today, a little bit over 1.5%. And that's where that whole thing about bonds and bond-like instruments truly comes in. But do you find that this class of investments, if you will, are a big part of what helps your clients reduce their own stress and anxiety leading up to retirement?
Most definitely. Oftentimes, these instruments come with contractual guarantees for a specified rate of return and your money back at a specified date. This factors in to significantly reduce the risk of outliving your money and having the fear that many people have in retirement of outliving their money or perhaps having to go back to work or something else.
And for somebody who still wants to have a little bit of growth, who still wants to be in the game, they can still be in the game and get yield if they focus on higher dividend common stock strategies. Now, granted, dividends can be cut. It's not as sound as investing by contract, but if they want to be in the game because they want some more upside potential, they can kind of sort of have their cake and eat it too, to a certain degree. That is, if they have the right risk tolerance.
That's correct. It's not an all or nothing proposition. We do have ways of investing in dividend stocks, high-paying dividend stocks that are less volatile and more stable than perhaps some of the high-flying tech stocks that you see out there.
Sure. Okay, final thoughts. We're getting into year end now. We're getting close. We got a couple months left. Final thoughts for those watching this video. Words of wisdom that you can bestow upon them if they're retired or within 10 years of retirement.
Well, the best advice I can give is if you're at or near retirement, now is not the time to wait to plan for better income streams in retirement. Since 1950, the PE ratio right now is at its highest level since just before the dot-com crash, which, as I spoke about earlier, led to a 13-year period of zero growth on the S&P 500. Anyone at or near retirement can't sustain a 13-year period of zero growth on the S&P. They don't have the time to wait that out. So, it's time to seek the advice of a retirement income specialist and not wait. It's not a question of if there's going to be another correction. It's just a question of when.
Yeah, and I saw that PE ratio chart that you sent me a couple days ago. I thank you very much for that. I appreciate you sending me these things as fodder that we can certainly use on the show. So, Eric Lardner, thanks so much for joining us. It's been our pleasure.
Thanks so much, Dave.
And you can reach out to Eric at abundantwealthmanagement.com. And if you enjoyed this interview, make sure you subscribe to our channel for more interviews with financial advisors from around the country.